Bounce back after a weak start. Realty and consumer durables are the top gainers while IT is the big drag. Accenture cuts its FY24 revenue guidance to 1 to 3% from 2 to 5%, pointing to weak discretionary IT spending and dashing hopes of a recovery in the second half. The news weighs down Indian IT counters. Prestige Estates buys over 62 acres in Indirapuram, NCR for 468 crores to build an integrated township with a development potential of 10,000 crores. The stock perks up following the big bet. And Texmaco Rail floats a 250 crore QIP and Karnataka Bank launches one to raise 400 crores. The offer comes a day after Wockhardt launched its QIP and soon after Coforge expressed its intent to raise 3,200 crores. Hello and welcome to Halftime Report. I'm Sonia Shenoy and with me is Mangalam Malu, who will just join in a bit. For now, the market is looking very good. The Nifty is hanging on to the 22,000 mark. In fact, building on to those gains actually. Despite the weakness that we've seen in the IT names, it's not a bad showing at all. In fact, the Bank Nifty is up over 200 points as well. And auto stocks are the ones that are moving up with quite a bit of strength. It's only and only IT that's playing a bit of a dampener because of the Accenture guidance cut. But other than that, it is not a bad opening and not a bad day for the market at all, Mangalam.
Not a bad day at all, Sonia. You know, one would have worried that, okay, after the rally that we saw yesterday, today, IT may play spoil sport, but despite IT, we've done well. Not only have the lows been brought into, if you just take a look at the IT index as well, that too has recovered a fair bit from the lows of today's trading session. Case in point, something like an HCL Tech at one point was down almost 5%, but now as we speak, it's down just about 2% So there has been recovery in a lot of these IT heavyweights itself. And to add to it, we are seeing decent moves coming by from the Nifty Bank, ITC and Reliance, all the big heavyweights doing well. But the real meat of the market is the broader market. 1,700 stocks advancing for about 600 stocks which are declining. Sonia, bulls will go into the holy weekend quite happy.
Absolutely, they will. And, you know, volumes could be on the lower side next week, right? Considering it's just 3 working days. But be that as it may, so many stocks in focus today. Footwear companies Bata and Metro Brands are in focus on the back of a Goldman Sachs report. Mangalam, what are you picking up?
Well, shoes for one, but importantly, you know, the footwear space has been quite a buzz over the last few trading sessions because earlier in the week we had a report that came in from DAM Capital. They were positive in the space, and at the start of the year itself, you know, Motilal Oswal did pick Metro Brands as one of the stocks of the year. Currently, both of them are holding mildly in the green, but Metro Brands, remember, has been a big mover in this week itself. A couple of days ago was a double-digit gainer on the index. So what exactly is Goldman Sachs bullish on? In the footwear space, branded footwear is actually, you know, seeing a rise in penetration. That was something that the street was anticipating post GST that came in too. So, you know, the unorganized to organized theme is one of the big triggers. Is actually decreased from around 85% to 75% of the market. That's the unbranded place. And as a result of which, even the top brands, 40 to 60% are consolidated by just 15 brands itself. So who stands to benefit from this? A store that sells multiple brands of these shoes. So this is something that, you know, Goldman Sachs is bullish on. And what kind of shoes? Sports and athleisure. Goldman Sachs believes that, you know, this is a business that can compound at a 13% CAGR over the next 20 years. So anyone who's looking to buy sneakers, sports and athleisure would look at some of these brands. And for Metro Brands itself, which is seeing a small contribution coming from sports and athleisure, by FY35, this number could go all the way up to 17% because of their deal with Fila and also the impending tie-up with Foot Locker. For Bata, everyone's liking what Bata has done with its portfolio assortment and premiumization, but they need to wait to, you know, see the kind of growth that Bata will post as a result of this change in assortment. So what is it that they have? Goldman Sachs has an initiate with a buy and a target price of 1450 on Metro. And the other one is 1470 target price on Bata. With its current market price, it makes it a neutral. So that's about the footwear space.
Okay, the footwear space. Well, moving on, all 3 oil marketing companies, HP, BP and IOC, are surging in trade. Sonal is joining in with the bull versus bear take on these stocks coming in from CLSA and Nomura. Sonal, over to you.
Thank you for that. Let me start with CLSA. They have reiterated their sell on these three stocks. Remember, earlier this year, they had downgraded all these stocks, and now they say the Brent breakout at $88 per barrel is the break-even point for marketing margins as well. And any further move in the crude price could leave investors worried that marketing margins could turn negative, especially for HPCL because it has the highest exposure to marketing segment. Given the upcoming national elections, there is a little less than probability that there could be any price hikes going forward. That would mean that even if crude prices hike, they will not be able to pass it on to the consumers as well. They reiterate their sell on IOC, BP and HPCL as well. On the other hand, Nomura has upgraded these three stocks, HPCL, BPCL and IOC. They've raised the target prices as well. They say that marketing overhang is complete with the recent price cut that came by last week, and the refining outlook remains healthy for all these three companies, and that's what they are bullish on. They say they are building in refining margins of around $9 per barrel for FY25, FY26, and investments in refining and favorable crude sourcing. That has led to better refining margins for this company. The premium to Singapore GRMs has been anywhere between $2 to $6 per barrel or $2 to $8 per barrel actually, and this is versus the discount that was seen earlier. So this is going in the right direction, and they are very bullish on the refining side.
All right, Sonal. So that's about all the oil marketing companies. Nomura is bullish, and we have weakness coming in from the other brokerages as well. But Prestige Estates, all the real estate stocks actually have been doing very well over the last couple of trading sessions. There was a bit of a pause before that, and obviously before that, we saw a big move in these stocks already. Prestige Estates is one of them, up 5% after the company has acquired nearly 62.5 acres of prime land in NCR, Sonal.
Oh yes, NCR looks like an attractive market for real estate developers now. Prestige did have some presence there. Now they're looking at expanding it in that geography. The company, through its subsidiary, has acquired 62.5 acres of prime land in Indirapuram extension, which is in NCR. The cost of acquisition is for 68 crore rupees along with a revenue share here. And they say the potential or the gross development value could be above 10,000 crore rupees. Now, to give you some context, in 9 months of FY24, they've done sales of 16,333 crore rupees, and the company did indicate that they will be able to cross the guidance of around 20,000 crore rupees in terms of sales this year itself. They also had earlier indicated that their FY26 sales target is 25,000 crore rupees, which I think they will be able to meet in FY25 itself, going by their projections, and NCR would be around 3,000 crore rupees by FY26. But this is a project with value way higher than 3,000 crore rupees. Now let's talk about the NCR interest that developers are seeing. On 5th March, Godrej Properties bought 6.5-acre land in Noida for around 500 crore rupees to develop housing project. Last year, Signature Global, which has a big exposure there, bought 25.5-acre land in Gurugram. So it looks like with the rising prices, the rising demand, this is a hot market for real estate developers.
Okay, hot market for real estate developers. Well, Sarda Energy jumps in trade after its subsidiary Natural Resources Energy got a letter of award for a composite license. Nigel is here to explain this to us. Nigel, over to you.
Well, that's right. Sarda is buzzing in today's trading session on the back of news that Natural Resources Energy Limited, that has got an LOI for composite license. Now, why is it important for Sarda? Because they have close to around 51% stake in this particular entity that's got that particular license. The further details that they've given is it's for one iron ore block in the state of Maharashtra, and the composite license has been awarded by various authorities of the government of Maharashtra. So we'll have to see how exactly this changes things for them. But for the time being, the street has read this positively. The stock had corrected sharply to around the 200 rupee odd mark. But on the back of this allotment with regard to this composite license for mining of an iron ore block, that's the reason why the stock is up and about in today's trading session.
13% higher, Nigel. Thank you so much for that. That's about Sarda Energy and a bunch of stocks. But you know what? SMEs, they are the vital drivers of innovation and employment globally. Recognizing their crucial role within supply chains and their growing importance of sustainability, we're thrilled to announce a curated masterclass by HSBC presents CNBC-TV18 SME Champions Awards on the 22nd of March in Chennai. This transformative session offers SMEs insights into navigating sustainability, regulations, seizing growth opportunities, and capitalizing on investor interest. Also enhancing supply chain resilience to unlock potential and embrace a sustainable future. Don't miss this opportunity to propel your business forward and contribute to sustainable economic development. Register now and join to embrace a greener future.
Welcome back to Halftime Report on CNBC-TV18. Well, IT stocks are top of mind and are all under pressure after Accenture cut its fiscal year 2024 growth guidance. Rima joins in to tell us. Rima, what are the 5 reasons for the pressure that we're seeing on IT stocks today?
Well, 5 quick, things about what's happening with IT. First, Accenture has lowered the guidance. Now the company is guiding for a 1 to 3% revenue growth in FY24, which compares with a 2 to 5% growth. If you look at the organic numbers, there the cut in guidance is a lot more severe, and now the company is talking about organic growth possibly being negative. 0 to minus 2% is the organic guidance, and the margin guidance has been trimmed. The next question is, why has the company cut the guidance in the first place? What changed in the last 3 months? The company said that they are seeing further cut in short cycle discretionary projects. So the larger transformational projects remain intact, but the discretionary spending in smaller projects is getting hit further, and that's the reason for the guidance cut. Now moving on to how does this impact Indian IT companies? Now the risk is that FY25 revenue forecasts get cut. Now earlier, the street was anticipating that there will be a recovery in FY25 after a dismal FY24. So consensus expectations were for a near double-digit growth. Now Accenture is saying that the outsourcing revenue is going to go up in mid-single digit. So is there a risk that we will see earnings forecasts, particularly on the top line, get cut? The pace of recovery will slow down. And I think that's the big, worry. In fact, the worry is also now that Infy and HCL Tech, when they give their guidance in April, will also have a cautious stance. Brokerage view then, CLSA says IT continues to remain in an earnings downward cycle, and it's not reflected in the current valuations. Morgan Stanley says FY25 consensus revenue forecasts are at risk. The pace of recovery assumed by the market could be slower than expected. But remember, there is an important caveat. Accenture's numbers are only till 31st of August, 2024, unlike the Indian IT company. So it's not going to capture the recovery which the street is baking in the second half of the fiscal year. The Indian IT, stocks, notwithstanding the correction that we are seeing today, in fact, they have been a bit soft. Month to date, the Nifty IT index is down close to about 7.5%, underperforming the benchmark index, with names like Infy, HCL Tech down nearly 10%. A quick word on what Accenture had to say about generative AI, because that's where all the hype is. Well, there is about a 33% quarter-on-quarter pickup in generative AI bookings, and for Accenture, the number stands at $600 million in the quarter gone by. Back to you.
$600 million. Wow, that's the buzz around generative AI, Rima. Thank you so much for that. In fact, earlier today we spoke with Manik Taneja, who's the Executive Director, IT Services at Axis Capital, to understand how this would impact Indian IT companies, what he would expect for them going forward. Let's hear him out.
Just like the excitement started to get built up across names, similarly, some of this disappointment will also percolate to almost everyone in the sector. This will possibly be a sort of a dampener for the likes of Infosys, Wipro, and while I would say that it will essentially have negative ramifications for almost everyone in the sector. From a number standpoint or from an outlook standpoint, I would presume that the guidance that the likes of Infosys and HCL Tech will issue amongst the larger companies may disappoint street expectations. So we're looking at the street expectations being in excess of 8% plus for Infosys in FY25, given significant possibility of improvement from a margin standpoint, from an operation standpoint. So that alone can be a significant driver of earnings growth for the name over a 3-4 year period. And that's the reason for preferring that name. Amongst the mid-cap names, Zensar is a buy for us. We have sell/reduce across most of the other tier 2 coverage universe.
Right. The other stock on our radar is Garden Reach Shipbuilders. Has gained nearly 81% in the last 12 months. The company recently entered into a contract with the Indian Register of Shipping for the development of green energy and autonomous vessels as well. As you can see, a big move on the stock. We had a word with the management this morning. So what was the insight that we got from them? This is our special segment, the Insight Edge. Upasna gets us more details. Upasna.
Well, we interacted with the management earlier this morning, and here are some of the important takeaways. In terms of order book, as of 31st December 23, it stands at 22,792 crores, comprising mainly of warships. Mind you that the management has given a guidance of 24,000 order book by FY24. The management says that the current order book will be executed by FY28, and currently the management is executing 4 projects with Indian Navy. So far, the company has delivered almost 71 warships to Indian Navy, and in terms of RFPs, the company has submitted RFPs for next generation corvettes is what the management has also highlighted. In terms of revenue, the management says that the revenue will cross 5,000 crores either by FY25 or FY26.
All right. In fact, we caught up with PR Hari, the chairman and MD of Garden Reach Shipbuilders. Listen into what they had to say.
Our order book as on 31st December 23 is rupees 22,792 crores. And this comprises mostly of warship building orders, and we are currently executing 4 projects for the Indian Navy. The current order book, as I mentioned, is 22,792 crores. And as per our execution strategy, this order book will be executed. This 18 warships plus our balance orders will be executed by FY28.
All right, so that's about Garden Reach Shipbuilders. Before we slip into a short break, just keep an eye on a couple of stocks. We have Indus Towers, which is doing well. In fact, it's had a decentish first 3 months of this year. The stock is up 30% in 2024 itself, currently at the high point of trade for Indus Towers. Stronger prospects for some of its clients, including the likes of Vodafone, means that it's good for their business, and that stock is up and about. Honeywell is the other one which has recovered from the lows, has moved into the green. Bharat Forge is the one which too has moved to the high point of trade. Mid-caps, by and large, doing well, though the Nifty has mildly given up some of its highs, and that's keeping it away from that 22,100 mark, near about which it was at the start of the show. Take a short break, come back, we focus on the markets itself. Soni Patnaik of JM Financial Services joins in with some trading strategies. Welcome back. There's been a recovery from the lows for the market, and as a result of which the Nifty is, 60 points higher, mildly off the highs of the day. But let's, give the bulls their due. We're doing well despite the weakness that we're seeing in IT. Because if you look at the contribution chart, it's the banks which have stepped up today. It's the banks as well as a couple of these other heavyweights, which include the likes of Reliance and ITC. They're doing well for the index. HDFC Bank contributing 80 points to the Nifty, and the Nifty Bank rather, 50% of the gains coming in from HDFC Bank for Nifty Bank. Intraday, we've seen a recovery from the IT stocks. So to the second, the second half of trade will be extremely crucial. Would there be profit taking ahead of a truncated week next week or not is something we will monitor. There are more stocks advancing than the number of stocks that are declining. But the fact that we've crossed above that 22,000 mark has gotten a lot of the put writers at both 22,000 and 22,100 pretty excited. And that's telling you that maybe the street believes that now 22,000 would be an important support to watch out for. The Nifty Bank is close to a resistance zone, which is the 20-day moving average, 46,921. So if the Nifty Bank crosses past that, only then we can see the Nifty to go past that 20-day moving average itself, which is 22,174. A lot of individual stocks in focus. Short covering witnessed in names like Laurus Labs, City Union Bank, a lot of long positions in a couple of these pharma names like Ipca Labs and Sun Pharma. Nalco may enter F&O ban, and Piramal Enterprises is the other one which may exit F&O ban. Okay, well, Soni Patnaik of JM Financial Services is joining us now to help us with some ideas and, of course, to tell us how to approach the markets. Soni, thanks a lot for joining in. For this market, looks like things have, of course, recovered a tad bit. Now back to the 22,000 mark, some sanity prevailing. What is the expectation over the next few days, considering it's a long weekend as well, and how should one approach it?
Good afternoon, Sonia and Mangalam. Thank you so much for having me on your show. I think rightly pointed out, 22,000 puts can be seen a lot aggressive writing. It is going to act as a very strong support going forward. Today is also weekly closing, and we must remember that rollovers from March to April series begins from today. So I think any close above 22,150 to 22,200 will give a very comfortable confidence to the bulls that it can test 22,500 plus levels by next week or so. I think that is the resistance for today. Only a move above that, you can see some more confidence coming in. However, in any worst case, we can still see a consolidation from 21,900 to 22,100. That could be the second best scenario. Not a lot to panic, but maybe the rollovers can indicate the further trend. Similarly for Bank Nifty, any move above 47,000, we can see that short covering coming in for Bank Nifty, which can lead it towards 48,000 also. I think these are the two levels to watch out for when it comes to the indices.
All right, and individual stocks, Sony, what would you look at?
Mangalam, the first stock would be Hero Motors. We've seen very good aggressive long beta positions today. There's a good breakout on charts. So I think current level you can buy on any small declines up to 4,600 can also be bought as a positional trade, keeping a stop loss of 4,500 and target of 4,900 to 5,000 can be seen in the coming days for Hero Motor. The second would be from the pharma space. It is in Syngene. Syngene, we've seen a rounding sort of a pattern taken out in charts. I think there's a good support of 680, but there's also aggressive put writing. So keeping a stop loss of 680 and target of 730 for Syngene.
All right, thanks a lot for that, Sony. Have a great weekend. We'll touch base with you very soon. Let's slip into a quick break. On the other side, we'll connect with Alok Agarwal, the CEO of Brookfield India REITs. Stay tuned.
Welcome back to the show. Let's focus on REIT Connect, a special segment dedicated to understanding the real estate investment trusts. Now, we have today with us Alok Agarwal, who's the CEO of Brookfield India REIT. Now, Alok, so good to have you in CNBC-TV18. Now, the one question that everybody is asking is, post-COVID, as people are working in a hybrid situation, the office demand, how is that panning out? And in terms of the matrices, has it reached the pre-COVID levels?
Thank you, Nisha. Thank you for having me here. So if you really see, commercial real estate is doing pretty well right now. It has really kind of gained momentum in last 15 to 18 months.
Right.
And there are a number of factors determining this growth.
Yes.
Let me just sum them up.
Yes.
The first factor is advent of GCCs, or
Yes.
growth of GCCs, and
Yes.
GCCs are global capability centers.
Yes.
And we have 1,600 of them in India, and every year we're expecting 100 more to open their offices for next 5 to 6 years.
Right.
And the best part is they are not here just for the cost arbitrage.
Yes.
They're here for talent.
That's
so
right.
That's going to lead a lot
That
of demand.
change has recently happened
Yes,
in GCCs with
absolutely.
the global MNCs looking at India in a more protracted manner. Yes.
Absolutely. So that's one. Second thing is Indian economy is doing pretty well.
Yes.
About 7 to 8% growth year on year. And
Yes.
you all know that India is a service-driven economy. So that's also going to lead to a lot of demand in office spaces.
Right.
And when you talked about pre-COVID and post-COVID,
Yes.
see 2019 and now,
Yes.
most of the IT companies, tech companies, their manpower has gone up by 20 to 80% depending on which company we're talking about.
Right.
And their real estate portfolios have either remained static or really have not gone up. So as companies, as employees keep coming back to offices, you see a lot of demand for office
Right.
going forward also, and still there. It's
Right.
gaining momentum. And last but not the least, the SCG reforms has been a game changer,
Yes.
both for developers
Yes.
as well as for occupiers. This means the companies which were not eligible to in SEZs,
Yes.
they can take space in SEZs
Yes.
in grade A kind of offerings,
Right.
campus developments. So a lot
Right.
of demand for commercial real estate sector now.
All right. So demand you're saying, but is there an impact of the kind of layoffs that IT startup world has seen and the hybrid situation? And tell us about the matrices, absorption rate. How is that now? And what is the projection for that?
See, if you really see, IT companies have been reporting flat headcount numbers for last 1 year. But I would say don't look at last 1 year, look at 2019,
Right.
where the growth is almost 20 to 80% depending on which company we're talking about. And you'll be surprised to know that last year we had 70 million square feet of a gross leasing,
Right.
about 40 plus million square feet of net leasing, which is highest in a year,
Yes.
more than what we had in COVID.
Yes.
And this year also we are expecting same numbers, 70 million square feet of a gross leasing and 40 plus million square feet of net leasing. So that's what we're talking about. As of today, we have 45 million square feet of a leasing inquiries in the market.
Right.
I'm not saying all of them get to convert it, but that's a number. And rentals are doing better.
Yes.
They have gained momentum, especially in core markets, they have increased.
Yes.
Because most of the supply is coming in peripheries, not in core markets.
Yes.
And even the peripheries are doing good. I would
All
say
right.
that.
So from absorption, demand and
Yes.
pricing front, it is looking positive.
Very positive.
All right.
Now, it's been a few years, and remember that REIT listings is a very recent phenomenon. It's been only a few years that all the REITs have been listed. Now, how is the traction amongst the retail investors as well as the mutual funds?
Also, valid point. First REIT got listed about 5 years back, and it's not a long time. And when the first REIT listing happened, the minimum amount for the retail investor was 2 lakh rupees. Then it decreased to 50,000. Today they can buy 1 unit.
Yes.
So that has led to increase in number of retail investors who have invested in REITs.
Right.
And also the great part is that this is a product where they get an annual yield. Large part of that is tax free.
Yes.
And there's also growth.
Right.
So there, maybe low teen to mid teen returns they can get.
Right.
And it's liquid, it's transparent.
Yes.
It provides them an opportunity to invest in commercial real estate sector of India.
Yes.
Mutual funds also are gaining momentum, and we are expecting further leg up because right now in India, REITs are classified as hybrid. We are hoping that they would be kind of given a state of equity that would lead to increase in demand from mutual funds and passive flows from ETFs as well as index mutual funds can come in, leading to growth of REITs as well as more liquidity.
All right. So IRA, which is the Reit Association that has been formed, it's lobbying hard for an equity classification of this particular asset class, and therefore more mutual fund traction can be seen. And when it comes to the retail investors, a small ticket size in terms of the property investment being liquid, tax benefit, as well as on the other hand, the assured cash flow every 3 months. So that is what we are looking at. And of course, the annuity-based and the foreign investors focused on infrastructure, real estate in the world are already your sponsors.
Oh, absolutely, absolutely.
So they see value in this particular product. All right, so when we focus on the growth potential, now Alok, this particular sector is also expanding. Commercial real estate is also taking different forms. What is the kind of growth potential that we see in this particular space?
So I would say immense growth. If you really compare from US, in US, the market cap of REITs is about 1.4 trillion. In India, it's about 12 billion, not even 1%. US is about 225 REITs. India has 4. So just look at how far and how far we can go. So that's one. Then if you really look at REITs, we have 3 office REITs. We have 1 retail REIT.
Yes.
Now we can have REITs in hospitality, we can have REITs in data centers, we can have REITs in hospitals, we can have multi-asset REITs, we can have residential REITs. So REITs, there's a scope for REITs to grow in size, in scale, and multiple sectors.
Right.
So that's where's the opportunity. And if you really see, REITs have a low correlation with other asset classes. So they provide a good diversification bet. And I think it's important that everybody should have REITs in their portfolio as a diversification bet.
All right, so diversifying the portfolio and having this kind of a property investment avenue.
Absolutely.
But Alok, when we look at the overall REIT and of course from some categories of commercial real estate, you're saying it's going to expand to many more. And we do gather that data centers as well as logistics, warehouse, all of them are really coming into the picture, the sectors which are the sectors of the future and growing. Now, when we talk about the challenges, what are the challenges that REIT sector is facing and could get simplified in the due course of time for the investors to take a bet on this space?
So, I mean, really, one thing is that there are new product 5 years back. So, investors are not so much aware about them. So, individual REITs as well as IRA, we have worked hard. We have worked hard conducting panel discussions, reaching out to investors. So that is something we are creating awareness and making the product more popular. So that's one thing. Other thing is globally REITs are classified, as I said, equity, and we are hoping to get same status in India as well. And once that happens, we can get more inflows. That's one. And also if that happens, the holding period for long-term capital gains that can come down. That's going to make REITs more attractive.
All right, attraction, but very quickly, if I have to say one thing which really differentiates a REIT asset class from pure play stock investment in a real estate firm. How will you differentiate? Very quickly.
I would say consistent, regular cash flows and growth all together.
Right. And with so many global investors coming, probably a lot of thrust is given on the corporate governance standards of REITs as well. Alok Agarwal, always a pleasure speaking to you and gaining more education on how REITs as a product is really panning out. So that was all about REITs on REIT Connect. With that, it's a wrap on this segment. Come back on the show for more news and updates and market action.
Welcome back. Well, for now, the market is holding on to the 22,000 mark and it is looking pretty good. It's at least a stable day so far. No movement on the headline index as much. The good part is we have pulled back from our lows through the course of the day and it's led by a lot of stocks. Auto stocks are once again, front and center in terms of gains today. So Hero MotoCorp, Bajaj Auto, Maruti Suzuki are all your top gainers. In fact, a stock like Maruti Suzuki is at a fresh record high as we speak, and that stock has now given us returns of almost 18% this year. So big moves coming into the auto space. Tata Motors, Eicher Motors are a couple of other stocks that are doing pretty well. On the flip side, though, apart from IT that is under pressure, you also have names like Divi's Labs, ONGC, NTPC that are slightly under the weather today, so down almost about 0.5% for these stocks. But let's talk about some market opinion. The Nifty has a 5% downside from here on, says Lawrence Belanco of CLSA. He gives us his view not just on the markets, but on the global space as well. Listen in.
Nifty's got roughly 5% downside, but the mid-cap index from current level still has roughly 10% downside. So we think there is still some relative underperformance, further volatility in mid-caps. Current correction unfolds down to the 200-day moving average, and that's basically around the 20,200. It will be slightly grinding higher even if we run through this correction. So we're looking at about 20,200 to 20,300. So that's where we think the floor would be, and a bit of time consolidating around that level. But like I said earlier, it doesn't break that longer-term uptrend, and we've still got targets sitting around the 23,000 area. Reliance does stand out. If you remember that the stock broke out of a two-year trading range, that you've still got longer-term upside targets of 34,000 to 35,500. And this current pullback that you've seen between 2,600 and 2,800 would be, I think, an opportunity to add exposure there. And with that limited downside, it should give you relative outperformance.
All right, let's take a quick break. On the other side of the break, Manisha Gupta joins in. She has with her Kunal Shah of Nirmal Bang Securities. Stay tuned.
Welcome back, and joining us now on the show is Kunal Shah of Nirmal Bang Securities. Kunal, hi, good to have you. And I want to start talking about metals first because it has been a couple of good weeks when you look at all the industrial metals there. And then, of course, in the last couple of sessions, there has been a slight profit taking, and that is because of the strengthened US dollar index. How would you look at these corrections, and would you say that these are now even better accumulation levels?
I think that there can be a room for another some more correction, because the way, on one hand, we get the news from the FOMC meeting that the rates are going to be cut at least 3 times during this year. But on another hand, the economic data which are coming out of US all are indicating towards the stronger economy. So there's a complete contradiction as far as the policy is concerned. So going forward, what I expect is some more profit taking can come in a near term because of the strength in US dollar, but the broader trend will continue to remain very strong going forward. So I'm quite optimistic about the overall outlook of metals, mainly because of the expectation of the easy monetary policy going to be adopted by UK. Today we saw Switzerland coming up with a quarter basis point rate cut, UK, US, all of these big economies, developed economies are going to cut their interest rate. And that is basically going to be very beneficial as far as the broader commodities and metals specific.
Kunal, so while you look at a further correction, I mean, as you said, there's still a way down from here. Where would you see, and how much more correction are you anticipating, and within what much time?
So I see a maximum, 1 to 2% correction, not much, when it comes to copper. Copper looks quite strong fundamentally going forward because of the expectation of a lot of smelters are going to cut their production from China. Aluminum maximum till 200 rupees on MCX, zinc maximum till 215 to 16. These are the levels where I will again, recommend to accumulate them. And I foresee going forward during the month of April, May, the rally should resume, anticipating the rate cut. So outlooks remains quite positive.
All right. There also is a report from Trafigura which says that there is never going to be a peak copper demand, at least in the not couple of decades going forward. And also by 2030, they expect that 5 to 6 million tons of a deficit is what we could be looking at by that time. So would you say a nearer term, a longer term does look bullish for copper, especially when you have a Citi and a Bank of America and a Goldman Sachs talking about levels of 10,000 and 15,000 going forward?
So it's all about how the new age demand, especially in the EV, from the EV vehicles. So the overall long-term brighter prospect of the copper is mainly because of the new emergence of the EV. Recently, what I've been reading about the EV and what I'm understanding is after a huge spurt in the European economies, in China, we are seeing again slowdown in the EV demand. So it all depends upon how the EV demand translates, especially for copper. But looking at the way there is a excessive smelting capacity going to go out from China, and the way India, Vietnam, Africa, some Latin American economies, the way the demand is emerging out of all of them. So just to give you a number, so India's copper demand is going to rise from 1.5 million ton to 3 million ton in next 4 to 5 years. So another 1.5 million ton of copper have to be produced more. And if you see the supply side, we are not seeing a major any new capacity being added. So this is going to be very tricky. And looking at the demand supply, yes, I would say that we are in a structural bull run. We are going to see bouts of correction due to negative news from China, but the structural trend is definitely on the upside. And copper, I will not be surprised even if this year it tests, 9,700, 9,800, or perhaps even $10,000. So the realistic targets are another 5 to 8% upside from here cannot be ruled out.
All right, so very, very bullish copper cues coming in there. Kunal, also another interesting development that metals clearly have seen is that Saudi Arabia, which is now clearly diversifying away from energy into minerals, metals, logistics, etc. And there have been reports suggesting that as standing, if there is an LME approval, then we could be looking at warehouses being situated in Jeddah, which is Saudi Arabia. I mean, as of now, and this perhaps would be a first in many, many years there, how are you looking at Gulf or Middle East as well emerging as a stronger player when it comes to metals?
Yeah, it's a need for an hour. The way the NEOM city in Saudi Arabia is basically getting built, at the pace it is, the way it is constructed right now. So we have Dubai right now, and now we are going to, after 5 years down the line, we are going to have NEOM. So this kind of warehouse in Saudi Arabia is definitely a need for an hour. And this is very positive from the LME point of view, from the metal market point of view. The more and more locations being created, especially in this part of the Middle East world where the demand is rising at a rapid pace, it is definitely a good move, and I would say need for an hour. So something what market wanted, and that's what they are getting.
Oh, yes, and a market to keep an eye on, absolutely. Kunal, you've spoken to us about copper, but talk to us about the ferrous metals also, because iron ore and steel, while on a month-on-month basis, are still trading in the negative, but this week has been quite bullish. There has been opportunity buying on the lower side. You also are looking at a Fed rate a cut coming in a certain future there. And then it also has been about the Chinese economic data, which is getting better. The month of Jan and Feb definitely has put in better numbers as compared to last year.
So when you track fundamentals of China and Chinese economy and the demand supply, and then on another hand you have a macro, that is the rate cut narrative. So when the rate cut narratives basically gets played, all commodities, ferrous, non-ferrous, everything gets lift up by the rate cut. So we are not talking about a quarter basis point rate cut. Every rate cut will have some sort of positive impact, not on a material basis but on the sentimental basis. So suddenly, whenever you see a rate cut, the mining players, the players, everyone wants to be in commodity whenever there is a rate cut cycle taking place. And that's what makes me believe that the worst is over for iron ore, for steel, for ferrous. I think the worst is over. And from the April month, we are going to see, in spite of all the negative news in China, we have not seen a crash taking place in the steel market in China. We've seen softening of steel prices. And now with the rate cut narrative, I am expecting steel prices again to move up. Even if the demand from China is not very strong, I am expecting another 4 to 5% upside in next quarter. And I think steel prices are going to go up in India, in China, everywhere. So my outlook on steel is bullish going forward. I'm not expecting a spectacular gain like we saw in the year 2021 to 2022, but a moderate 4 to 5% upside is something which is the base case scenario what we are working on. So my outlook remains quite positive on because of the macro factors.
All right. A final question then, Kunal, and you've been always bullish on precious metals as well, and gold has hit an all-time high, way ahead than the street, than what the street really thought these levels to be. I mean, these are the numbers we anticipated in perhaps the fourth quarter or the third quarter at best. With the bit of a profit taking that we are seeing right now, do you think this can further play out in sense of lower correction? And where do you see new accumulation levels?
Yeah, so it's just a profit taking, and you quite rightly pointed out. So whatever levels what people are working out in the second half of the year, they've been met in the first half of the year, not even first half, in 3 months of the 2024. So the run-up has been too fast, too soon, but outlook continue to remain bullish. There is no way, I mean, fundamentally, anyone would say that gold has moved up at a time when it should have gone down drastically. So last year, when the rate cycle in last 2 years, the US interest rate were at 5.5%, and at that time gold was at $2,000. So now with US rates are going to go down, Europe rates are going to go down, UK rates are going to go down. All these ETFs who have been the net sellers in the gold market from last 2 years, and these are the people who are buying Bitcoin and blah, 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 other asset class, they are going to return to the market. So gold market is already very tight. And in this tight market, I'm expecting in the second half, the ETF demand is going to return to the market. So we are in a market where historically central bank used to buy 300, 400 tons of gold. They are buying now 1100 tons of gold. And now the expectation of the rate cuts will bring ETF demand. So we are headed for a perfect storm in the second half of the year. And the moment rate cut in US will be announced, gold is going to rally. So my target, I'm working this year, $23 to $2,400, first $2,300, next $2,400. I'm quite optimistic. But yes, it's going to go up.
All right, Kunal, thank you so much for joining us. So very bullish precious metals and bullish in base metals as well. Kunal, as always, thank you so much for joining us. But with that, it's time for a break. Business Lunch will take all the action ahead.